you know, when we started getting on to technical trading 10 years ago, I remember most of the people I worked with thought that technicals were voodoo, you know, and that you know, it was kind of one of these things that was an intangible that didn't really work. Of course, 10 years on from there, we are all now here today because we realize that it plays a very important role in today's economy. So, you know, a lot of the time, I've sat down with people and I said, well, you know, what's the best strategy that you use, or what's the best pattern that you trade? And you know, I try to steer away from kind of the whiz-bang terms or the magic beans, so to speak, because what the most important thing I believe is when you're trading any instrument, whether it's futures, forex, foreign exchange, or equities, you know, is understanding the DNA of what actually makes it move in the first place. And that's why in December of last year we put together this workshop, which is the DNA of technical trading, which is to try and come back to the grassroots of where all movement stems from. So towards the end of the presentation today, I'd love everyone to kind of get together some stocks or some situations that maybe you're trading, or some problems that you've had, and we'll kind of attack it at the end. But keep in mind, as the disclaimer says, that while we may discuss those live conditions, of course, isn't a recommendation to buy or sell. But let's get cracking. Essentially, what I want to do today is I want to talk about, you know, from a top-down approach, what the market structure is. And you know, the reason why is, as I mentioned, kind of touched on before, I've sat across the table from investors or traders that have been dealing with, you know, $500,000, million plus dollars in the market, that have been very well educated, very well trained, but I'll go through you know, a pop quiz, so to speak, and say, well, okay, well, you know, what is an ascending triangle? And they said, well, you know, it's a bullish pattern. Okay, great. What about a rising wedge? And I'll say, okay, that's bearish. And so it's easy to parrot back, you know, what the answer is. But when I ask the question why, what makes it bullish or what makes it bearish, that's sometimes a more difficult question for people to ask, to answer, because they haven't been trained on the DNA of what actually makes these things work. So what I'd like to do today is kind of break apart a top-down discovery of what the market actually is, and how the smart money plays into that in terms of predicting market direction, and then how we can then build that into a process-driven checklist to actually start, you know, obviously making money. And that's ultimately what we all need to accomplish as traders, as running a business of trading, is we need to have a strategy that is consistent. We need to have a strategy which is measurable, not based on intangibles, things that are precise, things that you can put into a spreadsheet, so to speak, and how we can start building those types of process-driven methodologies. So one thing I always like to ask when we kind of go into a workshop like this is just to get an idea of where most people's directives are based. You know, do we have a group of day traders, people predominantly swing traders? And if you don't mind sharing that in the chat box, that'll just help me to try and angle or gear some of the examples and live situations we talk about today to where the majority of the group is focused. So a little bit about myself. I'm a swing trader and a day trader, and I utilize options to leverage those moves. But the term that I much prefer, rather than day trading or swing trading, is target trading. So I'm a huge believer that the market is very organized chaos, that a stock does not change direction because of some news event or some random occurrence. It is very precisely organized through specific levels of support and resistance, and a stock will not change direction unless it hits one of those. So whether I'm day trading or swing trading, the most important thing that I focus on is where is that support, where is that resistance, and almost every trade I do is already programmed in well before I execute. So a target trader is how I would consider myself. So I see we've got a good mix here of day traders and swing traders, which is excellent, because this is very specific to that type of time frame. So the other question I'll put forward, which is probably more predominantly relevant to today's topic, is how people make their decisions. And in today's modern world, you know, we've got so much noise. We've got Facebook, stock twits, you know, BNN, CNN, you name it. There's so much there that you know, how you get your ideas for trading is a vast quantity of resources. A lot of people get it from, as you can see on the screen, you know, the news, tips from friends, brokers and newsletters, or maybe things you're familiar with. And that's a picture of Vancouver, actually, which is where our head office is. Now, none of these things are, you know, on their own. Well, I should say, none of these things are necessarily bad. There's no problem getting your ideas from many different sources, but how do we quantify them? You know, so when you get a good stock tip, a good idea, what funnel do you put it through to see if it's a good trade or not? And that is really the difference between making money or not, because you can buy the right stock at the wrong time, or you could buy the right stock at the right time and not get out at the right time. So how do we measure, you know, what our strategy is and where we want to trade? And most people, you know, don't have specific ways to trigger entries and exits, or ways to, you know, evaluate in a very precise way what the opportunity is. And what that means is that we're left with, you know, very airy-fairy, if I can use that kind of very Australian colloquialism. We're left with these kind of airy-fairy methodologies like failing to limit losses, emotional decision-making, following public information. Even to this day, after 12 years of professional trading, I still find that from time to time, I'll get convinced out of a very good trade because another trader alongside me says that he wouldn't trade it, and I end up getting convinced out of it, get emotional. So the trick to the success that I found has been obviously eliminating this emotion as much as possible. And the only real way we can do that is with measurable, concise strategies. And the lack of those, I think, is why most people fail. The amount of people I've talked to that have said, you know, oh, gee, I'm not going to become a trader because I just talked to so many people who lose money. You know, my response to that is, well, most people do, because most people are very bad at it. So, you know, don't get persuaded by all the people that are losing, because those aren't the people you need to listen to. Most people lose money because they invest emotionally. They don't follow their rules. You know, for a great example today, I was talking to a trader. A stock was heading up into resistance, and he said to me, "Gosh, look, I really think that's going to break resistance." I said, "I absolutely agree with you, Doug. I think that's going to break resistance too." But and the purpose was he was going to buy it before it broke resistance so he could get that extra little bit of profit. But this is completely the wrong attitude, because we really need to make sure that we're not following emotional greed and we're buying once it breaks through that level. So what we need to do is start eliminating, you know, all of this noise, all of this garbage that that takes us in the wrong direction. And there's a lot of it. So let's go. If we go forward, what you'll see is a large quantity of different types of things that we can look at as opportunities. Now, the first thing I'd like to do is just define exactly what the market is. Now, if you prescribe to the Dow theory, what Charles Dow theory, the first thing he talks about is we've got three market directions. Obviously, it might seem simple enough, but we've got up, down, and sideways. And the classical technical definition of an uptrend, of course, is higher highs and higher lows. Now, I'm going to challenge that later because that is not necessarily true. That is a basic understanding, but flawed. But this is how most people make money. Most people make money in the up direction. 80% of people make money only in the up direction. And the number one problem with that, of course, is you're missing all of the other movement. You're missing down market, which is where a lot of money is made, of course lower highs and lower lows, and also the sideways markets. And this is when a market isn't going anywhere at all. And this is also a direction to consider because there's a lot of money made in this also through selling spreads and option strategies. So you can make money from all three directions. So if you're limiting yourself to one, you're significantly decreasing your opportunity exposure. The other thing that's really important to point out in terms of defining what the market is that, and this is not very often taught by most standard courses, it's very important to understand that the market has three distinct personalities. First is oscillation, and that is where a stock or whatever instrument you're trading is bouncing back and forth between two linear levels, two kind of strict horizontal lines. And this is oscillation. It's kind of like a heart monitor, going back and forth, back and forth, back and forth. And that is the system that controls the stock, the thing that prevents it from going higher or lower. And therefore, what defines where we buy and where we sell. Now, oscillation is an excellent way to make money. Most people say, oh, it's just noise, difficult to trade. Not true. It's a great way to make money because things are just, if you can get something going from 9 to 10, 9 to 10, 9 to 10, it's a money printing machine if you can identify it. So it's important to understand that is one concise area. The second type of personality is consolidation. Now this is also a type of oscillation because we are bouncing between two linear support and resistance areas. This is what you can see here in the middle of the chart. But it's directionless. So essentially the range of the trading is getting tighter and tighter, ready for a big break. And of course consolidation, most people would say is a difficult methodology or a difficult pattern to trade. But there is a way also to predict how where these breakouts are going to go to also, and we're going to get to that. But the third type of personality then is momentum. And momentum is where, obviously, what most people start their technical analysis career in, which is where the instrument has significant reinforcement of buying pressure on an ongoing basis. And and this is where techniques such as moving averages, MACDs, stochastics, all those kind of commonly known indicators are often used is within a momentum-based system. But most people don't effectively differentiate between the three. And just ask yourself, how many times, and who here has been in a situation where you've seen a stock that has bottomed out, and it starts to rally back up. It crosses the 9-day moving average or the 8-day moving average, depending on what you've been taught, and you buy because you've been taught to buy when it crosses the 9-day moving average. Maybe the RSI goes up through 30, which is a momentum entry signal, and you buy it, and then the very next day, almost as if the market's looking over your shoulder, the thing tanks again, and you get stopped out. I mean, I'm sure everyone's had that experience. I have. The reason, most likely, is that you've misdiagnosed a momentum trade when it actually was an oscillating trade. So having an understanding, an intimate understanding of that is very, very important. So the next thing that I'll ask is then, what is exactly your strategy, and do you have one? So a question I always ask every new student that I work with, no matter what their experience level, is I give them a pen and paper, and I tell them to draw exactly what the perfect chart looks like if they were to buy. So how many people know what that would look like, and how many don't in the group here? So when I say exactly what the chart would look like, what would the candlesticks be doing? Over the last 10 days, what is each candle doing? Where is it closing in the range? what is the volume doing? What is the chart pattern? And then once you've defined that, what indicators are you using to reinforce that probability? Because it's very important to know what we're looking for in order to trade properly, right? Think about anything else of significance that you purchase in life. Think about if you're out to go buy a car. You know it's going to be a four-seater. It's going to have ski racks on the roof because you like to ski. It's going to have airbags because you're not a good driver. Right? Well, hopefully not. Because you know what your criteria are. You know what you want to buy and what is a good price for that purchase. But most people don't apply that in the stock market. So when you don't know what you're looking for, it's easy to get a bad deal. When you don't know what you're looking for, any stock will do, or when you don't know where you're going, any road will take you there. So defining exactly what we want in a trade is imperative, not just from a continuity or consistency standpoint, but for efficiency as well. Because if one of my business partners told me this one day. He said, John, if you do the same thing more than once in a day, program something to do it for you, or hire some $10 an hour person to do it for you. Because if it's the same job every single time, why are you doing it? And this applies to trading. If you know what you're looking for, why would you be sitting in front of a screen all day long waiting for it to happen? You can automate this. You can program your trades. You can set up your brokerage account to get in when a certain level is triggered and get out when the resistance is hit. You don't need to spend as much time as most people do if you know what you're looking for. So that obviously begs the question, what should we be looking for? And to answer that question, I think we need to ask a very basic level, or explore a very basic level topic, which is what controls the market. The simple answer to that is volume. Volume controls the market. So whoever controls the volume, or wherever the volume is being driven from, is going to be the most important factor to consider. Now, 20 years ago, fundamentals drove the market. That's where the baby boomers came from. You got your news once a day through the newspaper, maybe the television, radio station. You call into the IR firm that runs the company and chat to them about the value of their what they're doing. And then maybe you phone up your broker on a pulse dialing telephone, and maybe by the end of the week you own the stock. So you've got a slow-moving, value-based system, and that was what drove the market. So the difference is that these days, it's almost extinct. These days, 70 to 80% of everything that happens in a day comes from algorithms. It comes from computer-based buying and selling. And this is, of course, is commonly known as high-frequency trading. And this has been the case now for many years. And how they make these decisions isn't based on value most of the time. Most of these decisions are being made purely by yes-no equations. Buy at 10, sell at 11. Buy it back at 10:30, sell at 11:20. They're preset, rule-based patterns that have been programmed for a long time. And the interesting thing about that is that while 95% of people lose money, these systems make a lot, billions and billions and billions. And if you've watched the 60 Minutes expose that they did on this a couple of years ago actually, that there were some firms they interviewed that hadn't had a single losing month in 2 or 3 years. So how do they do that? They do that through having a control of the volume. And when you control the volume, you control the market. That's why they call them market makers. And if you look at things like the flash crash of 2010, you can see the power that they have. when a certain amount of future contracts were triggered to sell on the S&P 500, it caused the market to domino effect and crash 1,000 points in minutes, give up months and months of gains in moments. Not only that, but went straight back up in the opposite direction just as quickly. This had nothing to do with people. It had only to do with the power of computers and automated trading. So if you think that the retail investor has any real influence on where stocks go, look at that day to show what we're fighting against. But that might sound scary, but the real opportunity in that is that they're not very intelligent computers. They don't think. They don't have a bad day because they had a fight with their spouse. They're simply following rules. And anything that's rule-based, that does the same thing again and again and again, can be reverse engineered. Where people get lost is that there's so much to look at. There's approximately 100 plus different patterns that the stock market trades in. So you think most people are familiar with a double top, but that's not it. Within the formation of a double top, you have I'll get my pen out here just to kind of give you an idea. Within double tops, you have Adam and Adam double tops. You have Eve and Eve double tops. You have Adam and Eve double tops. You have Eve and Adam double tops, and so forth. And the difference between these is significant. An Adam and Adam double top ranks 13 out of 100, with 1 being the best pattern, 100 being the worst. An Adam and Adam double top ranks 13. A Eve and Eve double top ranks 42. So the probability of an Eve and Eve double top versus an Adam and Adam is significantly different. And I would never trade that as a short. So I guess where people get lost and lose money is that they try and study everything, and you can't be good at everything. The trick to really successful trading that I found is to and what I spent the first 4 or 5 years of my career doing was studying these 100 plus patterns to find out which was the highest probability in terms of wins versus losses, and more importantly, what was the highest profitability. So how much do you make when you win? How much do you lose when you lose? And then predictability. So once you've found this awesome strategy, how many times a month can you actually find a tradable opportunity? And so going through these 100 different patterns, the key was to find the top group of, say, 5 or 6, and then specialize in those, because it is about quality, not quantity of trades. So in determining how we start to trade these opportunities and looking at then the structure of the market, the first most important thing that I always tell any trader to commit to memory is that every stock in the market, in my opinion, will not change direction unless it hits horizontal support resistance, trend line resistance, or moving averages. So your first job when you look at a chart, and we'll do this with some live stocks here in a moment, your first job when you look at a chart is to put on your investigator's hat and look at the price action and say, okay, if I believe that the stock didn't change direction unless it hit something, what did it hit? And once you can start identifying where the real support and resistance lines are, that's going to leave you with a pattern based on how those lines converge or whatnot, or moving averages. And once you know the pattern, then you know how to trade it. So let's talk. Sorry, before we go on. So basically, what I'm saying is that algorithms in high-frequency trading models and so forth don't see this. They don't see what we look at. They just see levels. So if you want to take on a very basic but effective strategy to trade with, if you can properly identify where support and resistance is, buy a stock as soon as it hits support and sell it before it hits resistance. It's easy. We day traded, I think, 13, 14 trades on, what are we today, Thursday? On Tuesday. Out of those 14 trades, we lost on one. And the key to that successful day was just never challenging resistance and selling. In other words, as soon as it hit any kind of resistance, we're out. So whether that's for a $50 profit or a $500 profit, out immediately, and selling the moment it breaks through support. And as I'll flick through here a bit, so that's the basic approach. But to have a more advanced approach, what we need to do is know where the best and strongest levels of support and resistance are. So rather than looking at a stock and saying, what should I do now, which is how so many people trade, they react to trades. They look at the market and they say, what should I do now, as if there's a gun to their head and they have to trade it. You don't. Talk to a successful poker trader. And one of the things he will say to you, or she will say to you, is that the key to success in poker is waiting for the best hand, not playing all the bad hands, knowing the probability of what you're playing. And what bad poker players do is they just want to be in there to have fun. They play every hand, they lose all their money because they want to be in on the game. It's a hobby, it's fun. Garbage. A hobby is much more fun if you're winning. So don't give yourself that excuse. So in trading, we have to know what is the best hand. What are the aces? And then we need to discipline ourselves to wait for that opportunity and not succumb to the fear of missing out. So what's a high probability level? Well, this is what we're looking at here is the type of setup that would be most specific to how we would trade an oscillating stock, something that's bouncing back and forth in a range, whether it's ascending, declining, in this case horizontal. So in an oscillating stock, we're looking for where is the highest probability that the stock's going to change direction and shoot straight up. And what we're trying to reverse engineer here, or what we're trying to anticipate, is where are the high-frequency traders, where is the smart money going to just suddenly start buying? Turn the lights from red to green. So if that's what we're trying to discover, the first thing we need to look for when we anticipate support is we need to see a heavy drop, like a sharp downward, almost vertical decline on significant volume. So 20, 30, 40 million bucks a day or more, that just hits a magic point and goes straight back up. So what we're looking for is an aggressive drop followed by an instant aggressive rally. Not this. That is not oscillating. What we need is that sharp, aggressive rally, because what we're trying to anticipate is the kind of rally that when the lights just go from red to green and just massive buying happens. So if you think, and I'll give one more, you can probably tell I like analogies. Think of it this way. If you had 100-ton vehicle, if that was possible, 100-ton vehicle going 100 kilometers or 60 miles an hour down a and was able to come to an instantaneous stop, turn 100 degrees, and go instantly the exact same speed in the opposite direction, think of how powerful that would be. And that's the kind of power that the trading has. So that's what we're looking for, that type of reaction. The second thing we're looking for is, of course, how much it had dropped and how much it had rallied back up before. Because we're not interested, if we're swing trading in a 2 or 3% move, we want a significant movement. We want to see significant power. If we're day trading, different scenario, but we want to see either way.
Hi everyone, looks like we lost audio here just for a second.
Oh, are you back here?
Yes, alright, yep, got you back.
Okay.
Sorry about that.
Okay, sorry about that. Okay, so who here looks for more tests of support before you buy, and who here looks for less tests before you buy? What do you think is the ideal amount of times that support should be tested before stock? More or less? The answer is less. Now, and this is why, again, 95% of people lose money. People trade logically. They think, well, the more times something's worked, the probability. And this is exactly what the smart money wants you to think. Because once people have seen it bounce 3 times, well, now everyone's thinking, well, this is a no-brainer. But you need to, the less time it, less people have become aware of it, and therefore the smart people playing it out. So the ideal time to buy is after you've seen one bounce, you buy on the second time. The third time, still tradable, but much less probable. And after 3, forget it. Call the rule of 3. Go and look at any chart. Look at an ascending triangle. Look at a descending triangle. When we look at the live stocks here towards the end, you'll see that in the majority of cases, after 3 tests, either on the top side or downside, it will break. The rule is paramount in everything I do. So that's how we want to approach being purchase. We want to understand that they are bouncing between splits. We want to therefore understand that moving averages do not work. Looking at an oscillating stock, stop using moving averages. You'll send yourself broke. If something goes from 9 to 10, well, guess what? Moving average is 950. It's just going to cut through the middle of the stock. So buying when it breaks above and selling when it breaks below will kill you. Moving averages don't work on oscillating stocks as effective triggers. What we're far more concerned with is buying at the bottom and selling at the top. So when you're trading an oscillating stock, the ideal entry point is catching the falling knife. The ideal entry point is buying before it's gone up a single cent in an ideal world. And the sell point is selling before it goes down at all. So you're buying on the drop, you're selling on the uptick. So it takes discipline, it takes rules. Now, the other type of personality, of course, excuse me, I'll just actually flick through here. So actually, before we go to that, a quick little example. I was showing you this already, but so this is just an application of that. If you were looking at a chart that looked a bit like this, and you were saying, well, what should I do with this? Most people would say, oh, I'd buy it. It's at support. Okay, but is that aces? Is that the highest probability trade? Absolutely not. I mean, if you were to buy here on that second green arrow from the bottom, that's a low probability trade. The support's been tested twice already. It's a third test now. The amount of buying power coming from that level is small, it's just not there. The best trade out of these 4 possible arrows is to wait for it to drop to the bottom green, or to wait for it to rally to the top red. And those are your high probability trades because they've only been tested once and they're the most powerful. Why don't people wait? Because they're afraid of missing out. They're afraid that their stock that they're in love with isn't going to get there, and then they'll miss out on an opportunity. And that is not a good reason to buy or short a stock. Fear of missing out is a very big reason for why people lose money. So quick checklist, just to revert back. If we're looking at an oscillating stock, general checklist we want to be looking for is strong levels of buying, fresh levels of buying, and powerful levels of buying. And for those of you who want to look at an example of that, Aaron's is a perfect example of that. AAN trades 30 million plus a day. You know, it's not a penny dreadful, but it behaves immaculately well. It's about 85%, I think, institutionally owned. So only 15% of its stock trades freely in the market, and it trades so well that we've never had a losing trade on this. It's like stealing money from the market. Look on the left. Hits 24.50, bang, straight up to 28. So what you're doing now is you're almost, and in some cases you are, programming in your brokerage account a bracket order to buy as soon as it next gets to 24.50. A good till cancelled order, you just put there and leave it. And the next time it gets down to 24.50, which is months later, you're in and straight up again to exact same price, 28 bucks. Now you may notice that we have a similar kind of reaction here in October, where we rally up to 30. What are we here? 32.50. So again, we're almost pre-programming that buy, because there's a very high probability that, given the type of move we've seen, it's going to happen again, and it does. If you look to the right, we hit that again in late September, and then we go straight up, and then again in January of 2014, and we go straight up again exactly to 32 bucks and straight down from there. And we're talking about huge money. This isn't, this isn't mum and dad at home. This is big boys playing with big stocks, and it's highly predictable based on specializing in that pattern. Once you start to do that, then you can start adding your indicators. Then you can start looking at the more in-depth stuff. Now, with the other side of the market is momentum, and it is a completely different animal. If you're trading oscillating stocks, you're going to be using Bollinger Bands, you're going to be using CCI, you're going to be using Keltner channels, you're going to be using RSI, looking for it to be under 20 when you buy, as low as possible, really. But then when you switch over to momentum, it's a completely different game. You wouldn't use any of that other than maybe RSI. Okay? Everything that works in oscillating, everything that works well in oscillating trades are going to tell you not to buy in a momentum trade. They're not the same thing. If you're dealing with momentum, now you're dealing with directional movement. You're dealing with stochastics. You're dealing with MACD. You're dealing with rate of change. You're dealing with ease of movement. You're dealing with anything which is momentum based. And your entry and exits are completely different too, because if in an oscillating trade, we're anticipating that the major force that controls that stock is the horizontal or the static line. So therefore, we're expecting that the power of the move is going to originate from where it's about to smash into on its way down. Now, momentum is different, and this is why we don't buy support in the same way in terms of those horizontal levels. That's why we wait for it to break through the moving average, because the moving average is now the system of power. And so if we tried to buy support while the stock was still under the moving averages, we're actually buying resistance, because the moving average is the powerful system. So we change our strategy completely, and we need to wait for the stock to break that resistance overhead before we get in. So our risk-reward strategies change, everything changes. So I mean, this is a small stock. This is an example of one we hit last year towards the end. You can see that that break of the horizontal the trend line resistance, powering up through the moving average behind it, and you got a beautiful, easy trade from 267, I think it was, up to 313 before it ran into that overhead resistance. A larger stocks, Chipotle Mexican Grill, same thing. Yeah, it went from an oscillating pattern into a momentum-based pattern, as did most of the market, on the 26th of May. So again, identifying what type of system we're in is going to be gives you a huge increase in the probability of your success. Now, the next thing we then want to look at is where the smart money is going. And where the smart money is going is a key factor because it actually tells us, where is the guys that have done all the work for us buying? Where are they buying? No matter how smart you are, and I'm sure most of the people are smart in here because they're all following Reed. But you can sit there for as long as you want, trying to find the next best next Apple, but someone's already done that for you. And that someone has teams of people, floors of people that do nothing but this, that have gone through years and years of university studying nothing but that specific field. So you're going to compete with those guys? I don't think so. I mean, they've got satellites that look at Walmart parking lots, that take footage to determine how much business they're getting, to predict how busy they are, how busy their quarter's been. You've got people getting satellite footage of oil refinery drills to see if all of a sudden they're loading up on new personnel and equipment in an area that hasn't been reported to be being drilled yet. These are the kind of stuff you're competing against. There's software that costs hundreds of thousands of dollars a month that analyzes weather patterns and looks at where the hurricane's going to hit, and then instantly searches for what insurance companies have the most exposure to that area in seconds. That's what you're competing against. So as bright as I'd like to hope I was, I think that they've got more power. And so what matters most to me is where are they buying? And I don't really care why. What I care is where's the money flowing. Now, we talked about a few different indicators here in a here before, which is directional movement, ADX, stochastics, and so forth. And all of these things is ultimately driving at the same objective, which is there smart money buying? So when you look at a chart, I've got Sprint up here. I'm long Sprint at the moment. I'm having a speculative trade on that. If you look at Sprint, and we want to know, is this really something that can go anywhere? I said earlier that the technical definition of an uptrend is higher highs and higher lows. And I told you that was faulted. The reason why is because higher highs and higher lows doesn't necessarily mean that you've got an uptrend. What you really need is you need higher highs and higher lows, but you also need it to be going up on increasing volume. You also need it to be closing in the top half of the range. And ideally, you also want the range to be expanding. Because if it's making higher highs and higher lows, but the range is contracting, well, guess what? You've got a rising wedge, and that's something you would be shorting. So there's more to it than just highs and lows. And so that's why we look at indicators like stochastics. Stochastics look at where the stock is closing in its range. On balance volume looks at if the stock is going up with accumulating volume. What else have we got? Directional movement, ADX, looks at if the stock is making new highs versus lows. And all of this is just ultimately saying, do we have a real uptrend? So what I like to look at is a smart money indicator I use, Twiggs Money Flow, and what that does is it accumulates all those different factors into one. So when you have a scenario where a stock is declining, but your money flow is going up, that's a great divergence factor, which ultimately tells you that the consolidation that's occurring is being used as an opportunity for smart money to accumulate a position. Look at Intel, a great short that we picked recently for an earnings play. You'll see that as the stock was going sideways, and apparently the average price of the stock isn't really changing, underneath that movement is a dramatic drop in the smart money. And that was an easy short for buying out of the money $35 puts as it gapped down from 37 all the way down to 33. And those are big money makers. Another one we did, one that I just traded this week, was buying puts on VMware. Now,
hey, John, I don't mean to interrupt, but look at like 2 minutes remaining.
No problem.
Cool.
So VMware, same kind of thing. gap down, smart money coming out of the system. So this is kind of one of the key factors that you really want to look at, is then to combine an understanding of how these factors fit together from a structural standpoint of how these things all piece together. The final part to it then is, once you got that down to a key, is increasing the probability by focusing on the highest probability charting patterns. Now I'll fast forward to the end because we are short on time. The key to all of this is efficiency. You don't get into trading because it's another job. You get into trading because you want life to be better, easier, money to work for you. And so if you're sitting in front of the screen, whether you're a swing trader or a day trader, and spending a lot of time for just marginally extra results, you're wasting time. Time is worth more. So efficiency is king, and when you know what you're looking for and understand the DNA, you can scan for things, you can be efficient. So I'll tell you about the workshop we're doing. It's called the Ultimate Trader's Toolbox. So you receive this instantly when you sign up. We launched this in December, and it's by far one of the most successful programs we've ever done. We've had about 200-300 people go through it so far, with some extremely positive results. We launched that in December. This is the fourth time we've offered it. Basically, what it includes is 5 modules. Module 1 covers everything you need to know about the foundation of the market. Everything you need to know to basically understand what the market's about and how it works. Module 2 is that we get into Dow theory, understanding why people lose money, essentially, and all the different oscillations and different personality traits in depth, and how to actually really understand how the smart money works. Module 3 is where we get into the blueprint of the market, money flow, candlesticks, greed and fear, price action, understanding how kind of the market makers decide where the market's going to go and how they actually push it one way or the other. Divergence, very, very important, and we cover that in depth. Module 4, candlesticks, advanced candlesticks. This will basically give you the very intimate knowledge of what you're looking at. I'm not a big fan of all the whiz-bang, buzz terms, flying candles and shooting stars. Forget it. That doesn't make you money. You shouldn't need to know the buzz terms to make money. What you need to know is what price action tells you. And when you know that, it's very simple. You just follow the rules. The final module is one of my favorites, and that's scanning, and that's basically where we teach you how to take everything we've taught you over the first 4 modules. Each module is about 2 hours long, so you've gone through about 8 hours already by this point, and this is the cream on the cake, and this is how we show you how to then find the highest probability trades for success. How we found Netflix when it dropped, that was a 1,200% return. We'll teach you that. You get those videos. It's all in there. And scanning is what makes trading fun. It's what takes the noise out. It's what you need if you're going to be ultimately successful. I'll skip through the testimonial there. There's lots of them. Most important thing is the Q&A. And one thing that you'll also have access to as you go through these 5 modules is unlimited support from us, one-on-one, and every single student will get assigned their own personal coach that you can talk to and go through your practice with. So we're out of time. So if you do have any questions, you can most certainly send them into coaching@acornwealthcorp.com. I think we put that slide up here, and I'll just pull it up. So coaching@acornwealthcorp.com. It is limited to 50 people because there is because of the one-on-one nature of the support. So if you do have any questions or anything, please do email us in again at coaching@acornwealthcorp.com. But it should be you'll receive that immediately, and it's well worth taking. It should definitely dramatically have a significant increase on your probability of your trading. With that, I'll thank everyone for spending your time with us today. It's been a pleasure, and Reed, once again, thank you so much for having us.